Was some nervousness that erupted ever since the policy got done. Leif Eskesen, Chief Economist, India and ASEAN at HSBC, joins in to talk about that. Leif, morning. First, a word on what your takeaways were from the RBI policy and what you made specifically of their inflation indication.
My key takeaway is that it was a very, first of all, the 25 basis points were widely expected in the market as well, and we had also expected it. The policy statement was still very hawkish relative to the last statement. RBI is now clearly more concerned about inflation risks, upside risk to inflation, both from higher commodity prices and the second order impact that can have on inflation, as well as the direct impact. And also they were more explicitly concerned about the build-up in core inflation. So in other words, manufacturing inflation, stripping out food. So from that perspective, I take away that it was a statement where they signal more concern about inflation. I think other key aspects of the statement that are worth highlighting is that the RBI also would appear to be a bit concerned not to get sufficient helping hand from the budget this time around. They're concerned that the subsidy bill could turn out higher than expected because of higher international commodity prices. If that is not countered by additional savings elsewhere, then they seem to be concerned that the fiscal stance may not be as tight as it should be, which makes it more difficult for them to fight inflation. Another point I thought that was interesting about the statement is they do highlight emerging risks to growth. But our takeaway from that is that that just means that they will continue in a gradual fashion in terms of tightening monetary policy further. And we expect an additional 75 basis points in hikes this year.
Leif, morning. Since it has been established now that inflation, or rather the RBI has been quite hawkish in its tone with inflation, and inflation continues to remain above the comfort levels of the RBI. What is your sense of what is your personal inflation target? And I heard you mention 75 basis points for the rest of the year. Is that correct?
That's correct. Yes. I mean, we clearly believe that the inflation for this year is going to be well above RBI's comfort zone, and it's going to be probably also slightly above going into next year. So that's why we still expect another 75 basis point. This inflation problem is not going to go away anytime soon, and one of the reasons for that, as I mentioned, is that you are starting to see core inflation becoming more of an issue. So in other words, the strong demand in the economy is building up inflation pressures from that front. And those are the kinds of pressures that are going to linger for a while and keep inflation elevated.
And because of all of this, how tough would it be to meet that GDP target, and what according to you would be the growth targets for India now?
I mean, we certainly believe that growth for fiscal year 2012 will slow to around 8%. That's a current forecast. The reason for that is partly because of a base effect from the somewhat strong pickup in growth in 2011 fiscal year, but clearly the impact from monetary tightening and to some extent also fiscal tightening is going to slow down growth. But that's really needed. You need to slow down demand to ease these inflation pressures. So that's a necessary slowdown we need to see now, and effectively you need to have RBI help engineer that.
A lot of this, of course, centers around where crude trades at for the rest of this year, Leif. And many global brokerage houses we've been speaking with are actually working with a 105 plus target on Brent. What's HSBC's own expectations of crude prices this year?
I mean, a lot of uncertainties are surrounding this outlook, obviously, right now because of the concern in the Middle East. So what I would say is that at least in the foreseeable future, we're going to have crude prices stay elevated at current levels until the situation there gets resolved, hopefully. If it does get resolved late in the year, you could potentially see crude prices ease from current levels. But obviously, we would have to see some further progress there, and we would have to be in a situation where this unrest doesn't escalate to other more important oil-producing countries in the region. So I would certainly say staying elevated at current levels for a while still, and then potentially late in the year it could be eased down a little bit, but still remain quite elevated relative to last year.
You also track the ASEAN region, Leif. What's your own sense right now of how much collateral damage the entire region will suffer in terms of growth because of what's happened in Japan? And perversely, would you say that actually helps a market like India and China in terms of the fact that growth there is more intact than the others?
I mean, the terrible tragedy in Japan is going to have an impact on growth in the region in the short term, I would say. I mean, in Japan's case, because of these events, we are going to see consumption slow in the short term, partly for confidence reasons. There's also going to be disruptions to supply and production in Japan, partly also because of the shortages of power supply. So in the very near term, that is going to have implications for exports from Asian countries into Japan. Assuming though that the situation with the nuclear threat gets contained, then there is a possibility that relatively soon, over the near term, we'll start to see reconstruction in Japan. So that's going to mean that Japan will then, at that time, begin to import more construction materials and also various construction-related machinery. So that would benefit exports from the region of these particular products. In India's case, I mean, India's exports to Japan are relatively small, about 2% of total exports. So from that perspective, India is not that vulnerable, if you will, to the initial slowdown in demand in Japan. So you'll probably see a relatively small impact in the short term as well as in the medium term.
Coming back to our own markets, Leif, what are your thoughts on that fiscal deficit target of 4.6%? And given the fact that, you know, the way crude prices are moving and we have that issue of sharply lower fuel subsidy as well, you think it would be tough for us to meet that target?
Yeah, absolutely. It certainly will. I mean, I think it was it looked good on paper, the target at 4.6%, and I think it was an important signal that the government sent that they want to continue with fiscal consolidation. But I think ultimately it's going to be difficult to deliver. As you rightly mentioned, on the subsidy side, they're expecting the subsidy bill to be significantly lower than last year, partly because we're going to have the full year impact of the liberalization of gasoline prices. But with fuel prices more generally staying elevated as they are and are expected to be for this year, the subsidy bill is likely going to be more expensive. We could also see additional subsidies on food, including if the food security bill comes through. And I think we also have to keep in mind that the budget is based on growth assumptions of 9% growth in 2012 fiscal year. We have around 8%, as I mentioned. So I think revenues will also turn out lower than expected because they're predicated on higher growth and also quite strong pickup in tax buoyancy. So I think at the end of the day, we're going to be closer to around 5% in terms of actual outcome for the deficit.
Thanks, Leif, for joining in this morning with your thoughts. That's the view from HSBC, scaling down growth a little bit, worried about inflation, of course, and a little circumspect about that fiscal deficit target. The market